today we are here to discuss the legislation that passed on Friday, March 21st of 2014 that affects Minnesota income tax returns for tax year 2013. Again, only the items that affect tax year 2013 will be discussed today. We will be having another conference call with you to discuss the business income tax, the business-to-business tax, which was repealed, the estate tax, any withholding tax items, and then the gift tax, which was also repealed. After the legislative session ends, we will provide more detail on law changes that affect the years 2014 and beyond. And so before we get started with all the detail, I do want to go to our website and show you information on our website. You should see our homepage of our website up on your screen right now. Towards the bottom, you'll see a orange-colored button that says Tax Law Changes. If you click on that link, it will take you to a page where we are housing all information related to the tax law changes. Right now, you should see on your screen a web page that says New Tax Law Changes, and then it has 2013 middle class tax cuts. And so we're going to just briefly walk through what's here, and then we'll provide more information. So the general guidance, we're not going to click on that, but that is just a high-level overview of guidance that we've sent and shared. And so all of you, this really relates to the information that we sent you over the weekend as far as what our plan is for adjusting returns and what taxpayers should do. Then you'll see a list of the 10 middle class tax cuts, and we're going to open that document up. This is a list of the middle class tax cuts that do affect tax year 2013. So there were some tax changes related to the working family credit, the mortgage insurance deduction, mortgage debt forgiveness, debt deduction for educator expenses, tuition deduction, student loan interest deduction, some saving accounts deductions, some scholarships, and then IRA distributions. So we'll talk about these in more details, but this gives you a high-level list of the 10 items that we're going to talk about today and some basic information about them. First, I want to talk a little bit again, just as a reminder, about taxpayers who have already filed. We are asking taxpayers who have already filed their 2013 tax returns that may have been affected by the recent law changes to wait until they hear from us before taking any action on their returns. We will be working to identify and adjust returns that we have received. During the process of identifying and adjusting returns, one of three things will happen with the return. We will either adjust the return and send the taxpayer a letter explaining how it was adjusted, or we will request more information from the taxpayer and then use that information to adjust their return. And once we've completed adjusting the return, they will receive a letter from us as well. The third thing that could happen is that we will not be able to adjust the return. And if that happens, the taxpayer will receive a letter from us telling them that we are not able to adjust the return, and at that time they would need to make a decision as to whether or not they want to amend to take advantage of the tax cut benefits. So at the beginning of the tax season, we had a conference call with you, and we shared with you the different forms and schedules pertaining to the nonconformity items. There were many form schedules and instructions updated as a result of the new law changes that occurred on Friday. And what we're going to do is kind of talk through the different schedules with you and what those changes are. So first we're going to talk about the Schedule M1NC. The 2013 Schedule M1NC was the form that was used to calculate differences between the federal and Minnesota adjusted gross income. This is important because there are items of income and deductions that are based on adjusted gross income. The recent law changes make this schedule unnecessary, so you do not need to make separate complex calculations for Minnesota purposes anymore. So we'll walk through the form and explain what has changed and why you no longer need to do that. So On the Schedule M1NC, the wages, before the law change, there were 3 types of employee benefits that were exempt from federal tax but had to be included in taxable wages for Minnesota purposes, and that was the adoption benefits, the transit benefits, and the education assistance. Federally, taxpayers may exclude up to $12,970 in employer-provided adoption benefits from their federal taxable income. Because of the recent Minnesota law change, these benefits can also be excluded from Minnesota income. Taxpayers may exclude up to $245 per month in employer-provided transit benefits from federal taxable wages. And because of the recent Minnesota law changes, these benefits can also be excluded from Minnesota income. Finally, employers may provide up to $5,250 in non-job-related education assistance to employees without employees paying taxes on that assistance. And because of the recent law changes, these benefits can also be excluded from Minnesota income. In June, we instructed employers to begin withholding income tax on these benefits and include the value of these benefits on their employees' W-2s. These additional wages were reflected in box 16 of the W-2 when employers completed them. Taxpayers can ignore the value of these benefits when calculating their Minnesota taxable income, but they should not ignore any additional withholding included in box 17. When calculating Minnesota credits that are based on household income, such as the Minnesota Dependent Care Credit, Education Credit, Homeowners Homestead Credit Refund, and Renters Property Tax Refund, these benefits must still be included in household income. And we'll discuss household income in more detail in just a little bit. So line 2 of the M1NC included the student loan interest deduction. Federally, there were provisions, or several provisions dealing with the student loan interest deductions that were extended. These provisions affected what interest was deductible and when deductions phased out. The recent Minnesota legislation adopted these changes as well, and this means that you will not need to work through a 14-step worksheet to determine what amount of student loan interest is and is not deductible for Minnesota purposes. Line 3 of the M1NC was for the tuition and fee deduction and educator expenses. So federally, provisions that created above-the-line deductions for up to $4,000 of qualified tuition and fees and up to $250 of educator expenses were extended through 2013. The recent Minnesota law changes extended these benefits for Minnesota tax purposes as well. When calculating Minnesota credits that are based on household income, such as the M1CD, Minnesota Dependent Care Credit, the M1ED, which is the Education Credit, or the M1PR, which is the Homeowners Homestead Credit or Renters Property Tax Refund, these deductions must still be included as additional non-taxable income when calculating the household income. So now we'll talk a little bit about line 4. Which is the discharge of indebtedness on principal residence. Federally, taxpayers are not taxed on the first $2 million of discharged qualified principal residence indebtedness. Minnesota now follows this exclusion as well, and this may greatly benefit taxpayers who lost their home in a foreclosure or a short sale, or who had an amount of their mortgage debt forgiven. And we have brought up the M1NC on the screen for you, so you should see that in front of you now as well. So we'll talk a little bit about line 5 of the M1NC, and this is the amount received under certain scholarship programs. Taxpayers may exclude from federal income any awards they receive from the National Health Service Corps Scholarship Program and the F. Edward Hebert Armed Forces Health Professions Scholarship. Say that fast. 5 times, and financial assistance program. Minnesota now allows taxpayers to exclude these benefits from taxable income. So again, when calculating the Minnesota credits that are based on household income, such as the Dependent Care Credit, the Education Credit, and the Homestead Credit Refund and Renters Property Tax Refund, this income must be added back when calculating the household income. Line 6 the IRA distribution for charitable purposes, a federal provision that lets taxpayers age 70 and a half or older to exclude up to $100,000 per year in IRA distributions when the money goes directly to a qualified charitable organization, was extended through 2013. Minnesota law now allows taxpayers who take advantage of this federal exclusion to also exclude these distributions from their Minnesota taxable income. So for both federal and Minnesota purposes, these charitable contributions are now deductible as itemized deductions because they were not included in income. They are not included in income. Line 7, the Coverdell Education Savings Account. The federal law allows distribution from a Coverdell Education Savings Account to be used to pay elementary and secondary education expenses without causing the account beneficiary or the student to incur a tax liability. The Minnesota law now also allows the same exclusion. Talk briefly about line 8. This is certain dividends that are paid to non-resident aliens. Certain interest-related dividends paid to non-resident aliens are not taxed federally, and the recent law changes make these dividends also exempt for Minnesota taxation. Line 9, which relates to the accelerated depreciation for business property on an Indian reservation. A federal provision that allows special recovery period for qualified business property on an Indian reservation was extended. The recent law changes allow the same recovery period for these assets for Minnesota purposes. Line 10, we'll talk a little bit about the modified expensing for certain qualified film and television production expenses. Under an extended federal provision, up to $15 million of qualified film and television production expenses may be expensed rather than capitalized. Minnesota law now allows these expenses to be deducted the same way they are federally. Line 11. Depreciation of qualified leasehold improvements, restaurant, building, and retail improvements. A federal provision that allows a 15-year recovery period for qualifying improvements or building was extended through 2013. Minnesota law now allows this same recovery period, meaning taxpayers do not need to calculate separate Minnesota depreciation on these assets. Line 12. Is the modified depreciation for motorsports entertainment complexes. A federal provision that allows taxpayers to depreciate the cost of a motorsport entertainment complex over 7 years was extended through 2013. And for Minnesota purposes, taxpayers may now calculate their depreciation over the same 7-year period. Line 13, the election to expense advanced mine safety equipment. Taxpayers are allowed to expense 50% of the cost of certain mine safety equipment placed in servicing during 2013 for federal and now Minnesota purposes. And this saves Minnesota taxpayers from keeping separate depreciation schedules for these assets. Line 14, which the basis adjustment to stock of S-corps making charitable contributions of appreciated property. If an S-corp donates appreciated property to charity, the shareholder may deduct their proportionate share of the assets fair market value as a charitable deduction. For federal purposes, the shareholders reduce their basis in the S corporation by their proportionate share of the corporation's adjusted basis in the asset. Minnesota law now follows this rule, meaning shareholders do not have to calculate different federal and Minnesota basis. We have now completed walking through the Schedule M1NC, but before I move on, I think I stated something in error. When we were talking about line 6 in the IRA distribution for charitable purposes, I just want to reiterate, for both federal and Minnesota purposes, these charitable contributions are not deductible as itemized deductions because they were not included in income. So I apologize for that. Now we're going to talk briefly about the M1SA, which is the Minnesota itemized deductions. Schedule M1SA was a new schedule we had created for 2013, and that was used to calculate the difference between federal and Minnesota allowable itemized deductions. There were a number of federal law changes that caused taxpayers to be required to file this schedule and for these amounts to be different. The recent law changes make this schedule unnecessary. So in other words, Minnesota no longer requires different treatment of mortgage insurance premiums, qualified charitable distributions, or other itemized deductions. So this form is no longer needed. So we'll take a look at the M1M real quick. Line 1 of the M1M is the increased standard deduction for married taxpayers. The recent law change do not conform Minnesota law to match the increased standard deduction for married taxpayers. So again, they do not. So that as a result, married taxpayers who claim the standard deduction must still add back $2,050 or $1,025 to their Minnesota income, depending on whether they filed jointly or separately. So again, I want to reiterate that there was not conformity for that item for this year. Line 2, the limitation in the itemized deductions. Taxpayers no longer have their itemized deductions limited on their federal return if their federal AGI is $250,000 or less for single filers, $275,000 or less for head of households, and $300,000 or less for married joint filers. So for Minnesota purposes, taxpayers are subject to limitations if their federal adjusted income is more than $178,150 or $89,075 for married separate filers. Because Schedule M1SA is now obsolete, this calculation is now handled on the scheduled M1M line 2. So again, this calculation is handled on the M1M line 2. So M1M line 3, the personal and dependent exemption phase out. Taxpayers with higher incomes must separately compute a phase out of personal and dependent exemptions and enter in addition to their income on Schedule M1M. Taxpayers are no longer subject to the phase out of their federal return if their AGI is $250,000 or less for single filers, $275,000 or less for head of households, and $300,000 or less for married joint filers. But Minnesota's lower phase-out limits affect taxpayers whose federal AGI exceeds $178,150 for single filers, $222,700 for heads of household, $267,200 for married joint filers, and $133,600 for married separate filers. So just real quickly, lines 15 and 37 on the M1M, because the schedule M1NC and the M1SA are now obsolete, these lines have been intentionally left blank. So there should no longer be a value entered on these lines. And then line 19 of the M1M is the charitable deduction for taxpayers who do not file Schedule A. So taxpayers who took advantage of the charitable IRA distribution are not allowed a deduction for the contribution because the distribution was not included in their income. So for Minnesota purposes, taxpayers who did not file a federal Schedule A may deduct 50% of their total contributions that exceed $500. So that concludes the discussion of the M1M. Now we're going to turn our attention to the M1WFC and the Minnesota Working Family Credit changes in general. This is one I want to go to our website on. So the changes to the Minnesota Working Family Credit helped reduce taxes for middle-class families who file a Minnesota tax return. Like the federal earned income credit, Minnesota Working Family Credit increases as the taxpayer's earned income increases, and once a taxpayer's income reaches a certain amount, the credit begins to decrease until it is reduced to zero. The federal credit increases over the same range but decreases at different income ranges for married and single taxpayers. For tax year 2012, the Minnesota credit increased and decreased over the same income ranges for married and single taxpayers. And the recent law change means the Minnesota credit increases over the same income range for married and single taxpayers. However, the credit decreases over an extended range for married taxpayers. So to make this change easier, we have added an updated table to the online schedule M1WFC and M1 instruction booklets, pages 20 and 23. Again, that's pages 20 and 23 of the M1 instruction booklet. Now we're going to take a look at the one-page informational sheet we created to help explain this change. There will be some taxpayers in this category that we will not be able to identify. All the affected taxpayers who may be entitled to a credit. And we can't identify people in this range if they have never filed for the credit because we don't know the qualified dependents and we can't determine the earned income. So we have placed a one-page sheet that is out on our website to talk more about the credit and the changes. Again, it's under the tax law changes website. So as you help clients prepare 2000 Minnesota returns, we're asking you to watch for taxpayers who may now be eligible for the working family credit under the new law, particularly those we can't identify. So this sheet walks through the credit, what the changes are. There's a table there that identifies what it is and what they may be eligible for. And we are asking you to advise these taxpayers if they file before updated tax forms are available, that unless the return is also affected by another recent law change, they will need to later file an amended return to claim the working family credit. So I want to talk about that again a little bit. So again, as I mentioned, there is a population that we can't identify that may be eligible for this credit. And again, the reason why we can't identify them is because if they've never filed before, we don't know the qualified dependents and we can't determine their earned income. So as you're working with them, if they've already filed their return or you're going to be filing the return before the changes, before the April 3rd deadline, and they do not have any other tax law changes, then they will need to amend. And the reason why we're saying they do not have any tax law changes is because if the taxpayer has already filed and they have other tax law changes, we are going to review those returns and do one of three things. We'll either adjust it and send them a letter, we'll request more information and adjust it, or we won't be able to adjust it. And so we need your help in waiting to file an amend until we have the opportunity to look at the return that is already here and make any adjustments that may be there, and then file an amended return if they qualify for this credit. So that is the working family credit, and we're going to turn our attention now to the Schedule M1 PR, which is the homeowner's homestead credit refund and the renter property tax refund. We're also going to talk just briefly about Schedule M1 CD, which is the child and dependent care credit, and Schedule M1 ED, the K through 12 education credit. There were minor changes to all of these forms. When we're using Schedule M1 NC, all of the adjustments from the M1 NC were included on line 5, which was the additional non-taxable income. Even though Schedule M1 NC is now obsolete, there are items of income that were reported on Schedule M1 NC that must still be included in household income when calculating these credits. And they include the employer-provided adoption, education, and mass transit benefits, the home mortgage debt forgiveness, the awards from the National Health Service Corps Scholarship Program, and the F. Edward and Hebert Armed Forces Health Profession Scholarship. and financial assistance program. There are also deductions that were reported on Schedule M1NC that must be included as additional non-taxable income on line 5 of Schedules M1CD, ED, and PR. And these deductions are the $250 educator expense deduction and the tuition and fees deduction. So before we open it up for question and answers, I just want to let you know that we do have a conference call scheduled this afternoon with the software vendors, where we will be sharing this information with them as well. We have also sent some information to them this morning. On the website that you should see in front of you right now, we have added the individual income tax instruction booklet and the homestead credit refund and renter's property tax refund instruction booklets. So the instruction booklets are updated, and that's the current booklet with the new tax law changes. We're still working on the forms. We'll get those out just as quick as we can, but we wanted you to have the instruction booklets available to you so you can start thinking about these changes. We will continue to add information as we have it available out here on this website. I do want to encourage you as well, if you haven't signed up for our email notifications, up at the top of the screen you do see subscribe to tax law changes. If you click on that, you can add your email information, and there's a variety of lists that are available that you can sign up for to get information from the department.